So let's get started, shall we? First off, thanks to the real estate professionals for joining us. You know, the ownership and use of real estate is the backbone of the American economy. And this is because at the same time, real estate can uniquely represent a place to live as well as a place to invest, can it? It can be a residence, a tax shelter, and even a source of income. Also, because so much of our wealth and income can be associated with how real estate is bought, sold, and utilized, how it is going to be taxed is obviously a big deal. Now, as we begin, it might help if we lend a little context to what actually got us to this point in time as people in the real estate space. Now, as you all know, recently, after a lot of lobbying and a tremendous amount of discussion, Congress passed and the President signed a tax reform bill which will impact almost everyone in the country as well as their property. And again, as you know, this bill started out as something very different than what it is today. Do you remember? Originally, it included several provisions which could have proven devastating for property owners. Now, however, after the efforts of many, I think we as real estate professionals can be a bit relieved because a few compromises have been interjected into the final bill which benefit property ownership. And in some cases, some changes have been included which could be an absolute boon to certain types of property ownership, and that's what we need to look at again today. In a sense, the final bill represents a few trade-offs that we as real estate professionals need to understand so we better know how to advise our clients. So, what are the three big trade-offs? Here they are. Number one, we originally faced the prospect of absolutely no mortgage interest deduction. Remember that? And that has now been turned into a continued deduction of interest for new loans up to $750,000, down from what it was originally at $1 million. Number two, we also originally faced the prospect of having no more deduction of state and local taxes, or SALT as it is now known. And that has been turned into a $10,000 cap of state and local taxes, including property taxes. And number three, we originally faced the prospect of the complete elimination of Section 1031 exchanges. That could have been devastating, but we're able to get that turned into tax-deferred exchanging, staying for real estate, but being eliminated for personal property and collectibles. So if you had planned on exchanging your classic Ferrari for a vintage Lamborghini later this year, I have some bad news for you. Those days are now officially behind us. So let's see how we as real estate professionals can better understand the recent tax reform bill, shall we? Let's work our way through these slides, which will highlight the big changes. We'll start with the basic tax info and then move through the real estate oriented items, which we need to be very familiar with. So let's get started. Individual brackets. We'll be keeping the current 7 tax brackets, and it breaks down like this. For married couples filing jointly, effective January 1, 2018 and ending in 2026, the income tax would be 10% for income up to $19,050, 12% on $19,051 to $77,400. Then we go to 22% on $77,401 to $165,000. Then 24% on $165 and $1 to $315,000. Then you move up to 32% on $315,001 to $400,000, 35% on $400,000 and $1 to $600,000, and then 37% for everything above $600,000. And that's for married filing jointly. If you need the rates for singles, email me and I'll send them to you. Standard deduction. So, in a change expected to end the itemizing of deductions for millions of Americans, the new bill for 8 years, beginning on January 1st, 2018, will increase the standard deduction. That's a fixed amount that can be subtracted from your adjusted gross income to lower your taxable income. It is moved to $12,000, up from $6,350 for individuals, and up to $24,000 for married couples, up from $12,700. Alternative minimum tax. Running parallel to the regular tax code, The AMT is a separate set of rules under which some households must calculate their tax liability a second time. The AMT has a larger exemption amount, but at the same time it has fewer tax preferences. This design allows it to capture more income tax from households that would otherwise claim large deductions and therefore have less tax liability. So in the new bill, AMT is left in place, but is temporarily changed by raising its exemptions and phase-outs some more. That'll mean fewer people will have to pay the tax, while those who still do will take a smaller hit from it. Currently, more than 4.4 million households are subject to the AMT per year, though even more are affected by it. In fact, in tax year 2015, more than 10.3 million households had to calculate their AMT liability. We won't go into the full calculation on AMT, but if it applies to you, the formulation is easy to find. Corporate tax rates. Now, here's the biggest change in the new bill, which is thought to be a huge boost to the economy. Namely, the corporate income tax rate is permanently reduced to 21% from 35% as of January 1st, 2018. Pass-through rates for business income. What about pass-through rates for business income? Potentially one of the biggest wins in the tax bill for real estate will be changes to the way pass-through income is taxed. This change would mainly apply to individuals and family trusts investing in real estate through partnership entities such as LLPs, private equity funds, LLCs, or individuals who receive income from REIT dividends. This is because owners of pass-through entities are eligible to claim a 20% deduction for business-related income. For example, if an entity owns an office building that provides $200,000 in annual income to its investor partners, those individual investors could avoid paying taxes on $40,000 of that income if they are eligible for the full 20% deduction. The 20% deduction is for the first $315,000 of qualified business income for joint filers, pass-through businesses such as partnerships and sole proprietorships. For income above that threshold, the limits are phased in, producing an effective marginal tax rate of no more than 29.6%. State and local tax deduction cap. Here's a big change. There is now a cap of $10,000 for state and local taxes for both individuals and for married filers. Individuals will find it much easier to use because it's an itemized deduction. That means they take it if their total deductions are over $12,000, the new higher standard deduction. So a single person with the maximum $10,000 of income and property taxes and $3,000 of charitable contributions would be able to itemize deductions. A married couple at the cap of $10,000 of income and property taxes would need another $14,000 in mortgage interest, charity, and other deductions to get to the $24,000 standard deduction. Immediate expensing of personal property. This is another huge change. The new bill allows businesses to immediately write off or expense the full value of investments in plant and equipment for 5 years. Then it gradually eliminates this 100% expensing over 5 years beginning in year 6. Child tax credits. The new bill allows child tax credit doubling to $2,000 per dependent child under the age of 17, with a refundable portion of $1,400. The refundable portion allows families to lower their tax bills to zero and still receive a refund for the remaining value. Medical expenses. The deduction of out-of-pocket medical expenses is continued through 2019. Estate taxes, another increase in exemption. The exemption for estate and gift taxes is doubled to $10 million from $5 million per person and indexes the new exemption level for inflation after 2011. That means even fewer Americans would pay the estate tax, but it will stay on the books. Mortgage interest deductions. Okay, here's another significant change in the new bill. For residences bought from January 1st, 2018 Through December 31st, 2025, the new law caps the deduction for mortgage interest at $750,000 in home loan value. After December 31st, 2025, the cap would revert back to $1 million in loan value, and the deduction for interest on home equity loans is suspended until 2026. Commercial property owners, you will still be entitled to a full mortgage interest deduction. Depreciable lives for real property. Depreciation period for multifamily properties was 27.5 years, and for commercial properties, 39 years. 1031 exchanges. The final key change in the new tax bill is that the 1031 exchange can only be used to defer capital gains in the value of real property and excludes any value on personal property. Now keep in mind, this exclusion may have a negative tax impact on real estate assets that also contain a high amount of personal properties, such as restaurants that have a significant value tied up in the furniture, fixtures, and equipment. So, based upon what we now know, how do you leverage your new knowledge of the tax reform bill? Number one, target owners who may want to change in their circumstances due to the state and local tax situation where they're at. There are many owners who would benefit dramatically by selling or exchanging out of a property in a high tax state and into a suitable replacement property in a lower or no tax state. And there is no seller that would refuse to hear you out if you have a strategy that will enhance or dramatically improve their cash flow. Here's a second idea. Encourage owners to vest their investment properties into a pass-through entity for absolute maximum tax advantage. The automatic 20% deduction is more than enough reason to suggest to a seller that they create the appropriate entity in which to vest their property. Now remember, if it is your intention to have them change their vesting, remember that they cannot exchange out of that property immediately. They will need to season their ownership sum to firmly establish that as a 1031 property for the new ownership entity. But once again, a great reason to contact a possible seller and plant a seed for a future transaction. No? Here's the third idea. Target investment property owners who can 1031 exchange into better circumstances, maybe for a better yield or a better location. There are lots of new institutional and investment grade properties which are now available which weren't before. In fact, we have a webinar coming up in which we'll introduce you to some institutional property owners who will work with you and your client and get you paid for an investment grade property referral. And then lastly, because nothing impresses like expertise, make yourself the local real estate solutions expert for your market. Here's a suggestion. Launch your own voice-activated real estate app so buyers and sellers in your market who have specific real estate related questions can hear all about you and your expertise right from their Google or Alexa voice-activated device. It's a new idea, but it's also a great idea. So that is the new tax reform. If you have any questions, don't hesitate to contact us, and thank you for your time.